With gold, again, I think the central banks gave us a head start. I still think that $5,700 is probably conservative by the end of this bull market, but I tend to be more conservative. I don't have the legs to be a cheerleader. I don't think we're anywhere near the end. I think at the end of this market, at the end of this bull market, looking at 45-year cup and handle formations for silver, you're probably getting to $90 to $100 an ounce. At a 50-to-1 ratio, you're looking at least $5,000 gold at a bare minimum. But if you look at the Dow gold ratio, to get that down to 5, you either need $8,000-$9,000 gold, or the Dow's got to drop to 20,000.
Rich Checkan, a respected voice in the precious metal space, recently shared his perspective on the ongoing gold and silver bull market and why the rally is likely far from over. Drawing on long-term technical patterns and fundamental shifts in central bank behavior, he believes that gold's journey has only just begun. According to Checkan, recent large-scale purchases by central banks have effectively given investors a head start, signaling that institutional demand remains strong even as retail participation lags. He argues that by the end of this bull market cycle, $5,700 per ounce for gold could actually be a conservative estimate. Historical patterns and structural imbalances support the potential for even higher prices, possibly $8,000 to $9,000 per ounce, if the Dow-to-gold ratio reverts to historical norms. Silver, meanwhile, could outperform dramatically. Based on a 45-year cup and handle formation, Checkan projects silver could climb toward $90 to $100 per ounce, maintaining a 50-to-1 ratio to gold. In his view, the precious metals market remains in the middle of a long-term secular uptrend, not the end of it. The next phase, he says, could redefine wealth preservation for a generation. For more insights like this, don't forget to like, subscribe, and share your thoughts in the comments below.
So I think we can actually go much higher than that 5,700, gold price number, that we got a head start, if you will, from central banks. And that goes into the duration as well. These usually last about 10 years or more. We're not even there yet, but I think, again, with the central bank head start, I think we have an even longer horizon forward. Gold's going higher. You need to have it in your portfolio, no matter what your underlying composition is. For the longest time, with gold prices at all-time highs, the premiums were the lowest levels I've seen in 30 years. Again, that doesn't suggest this is an investor-driven bull market. It was strictly driven by central banks. That is starting now to change, right? So investors are getting into this market, and we can tell because central banks don't buy silver, they do buy gold. Investors buy both. So the fact that the silver price has been moving over the past couple months suggests that silver is now in play and investors are now still in play. So we're going to start to see premiums rise. And we are seeing it on a couple items, but not everything just yet. We're going to start to see delivery times ramp up as well. Instead of having something shipped out immediately when you wire funds in, there might be a 3 to 7 day delay before it goes out. And at the height of the bull market, it's going to be even longer than that. This is not uncommon. The folks out there that see this and they want a 100-ounce bar from the Perth Mint and they aren't going to get it, they're going to say right away, oh my God, Perth Mint is out of silver. And Jeremy, nothing could be further from the truth. Yeah. They're just being smart about this. They say, listen, people buy 1-ounce gold and silver coins. They buy kilo silver bars. That's where we're going to focus our minting attention in order to be able to meet the demand that we know and feel and see is coming. And it's just a smart move from their point. They're nowhere near out of silver. They just want to put it in the right forms that people are going to consume. We are seeing, bullion banks stand for delivery and ship that metal to London. A lot of that is to meet the demand there. A lot of that's coming out of India. And the bottom line is the metal was in the wrong place. Clearly, a lot of it was shipped from London to the U.S. in order to avoid the tariffs. They did it ahead of the tariffs, and then they got kind of stuck because it was not where it needed to be. I'm not big into that part of the market. Obviously, I deal in the retail sector, but I will tell you that my understanding here is the real liquidity has got to come from ETFs, and I don't know that those people are getting ready to disavow themselves of silver and gold right now. If Morgan Stanley, with 4.8 trillion in assets under management, goes ahead and shifts 20% of those portfolios from bonds to gold, 20% of 4.8 trillion is 960 billion. That translates to 240 million ounces of gold, with a kilo at 32,151 troy ounces. That means you're going to have 7,465 metric tons of gold needed to meet Morgan Stanley's demand. Let's put that in perspective with the central banks. U.S. is the number one holder of gold reserves at 8,133 metric tons. Mm-hmm. Over the past 3.5 years, the central banks have been buying at a clip of about 1,000 metric tons a year. So that's 3,500 metric tons of gold over 3.5 years has been enough to send the gold market to new all-time highs for several years on end, until right now investors are starting to wake up. Can you imagine the impact of just a part of the Morgan Stanley assets under management going into gold? I mean, that number is double what has happened already over the past 3.5 years to take us to this point. I do not see central banks slowing down. I think, and I've said this before, we need to follow their lead. They have created this problem. They expanded the money supplies that have led to price inflation. Okay. So the bottom line is, if they're taking these steps in order to protect themselves, I think we should pay attention and do the same for ourselves. If you look at the gold price, conservatively, we're looking at 2 to 3 times the previous bull market high, which was $1,900. So conservatively, you're looking at $3,800 to $5,700 gold. We're just smack dab in the middle of that range. And again, I think that's conservative, because this has been a weird market. We had price escalation, price appreciation in gold for a long time before the investors even got a whiff of this market. And it was all central bank driven. I think you can make the argument that we really only started over the past year or two to see investors participate in this gold market. And now we are just starting to see them participate in the silver market.
In a detailed market outlook, Rich Checkan explores how central bank activity has laid the foundation for a powerful and extended gold and silver bull market, one that could last a decade or more. He notes that early gains in gold were primarily central bank driven, not investor led, which makes the recent shift in investor sentiment especially significant. As premiums on gold and silver begin to rise and delivery times lengthen, the market is showing early signs of tightening supply. The movement of bullion between London, India, and the US reveals that metal is simply in the wrong place, not missing, but with mounting demand that could change quickly. Checkan emphasizes that if major institutions like Morgan Stanley were to reallocate even 20% of their portfolios from bonds to gold, it could trigger a massive surge in demand, requiring over 7,000 metric tons of gold, nearly rivaling total U.S. reserves. He believes central banks are not slowing their buying and that their actions signal a lasting shift. Investors, he says, should take note and follow their lead before the next wave of monetary demand fully takes hold. Let's get into the interview.
We see the gold, or the convergence. We see the gold-silver ratio down 35 to 50. We see the gold price hitting those targets, the silver price hitting those targets. The duration is somewhere 5 to 10 years down the line. When all of that comes together, interest rates are going up. The dollar is getting stronger, which, by the way, it is not. And I don't buy the past week where it went from 98.89 to 99.08. I mean, that's just not enough to show strength. Yeah. When all that starts coming together, then you'll know, and you can start easing your way out of the market. If you bought the metal for insurance, you're not going to sell it anyway. I don't care if it goes to $200. It's still going to do its job in terms of preserving purchasing power. But what you bought for profit, you would start selling, and I would average out of the market just like you moved into it. It's funny how every time there's a sell-off in equities markets, everybody basically comes out and says, just hold on. You need to hold on for the long term. There's no reason to panic, no reason to sell. You're fine. Your money's safe. Every time gold pulls back, everybody say, that's it. It's the end. Gold's done. Time to move on. why are you in it in the first place? And I thought we were seeing a change in that narrative, to be honest with you, when you saw the news come out where basically Ray Dalio was saying you ought to have 15% of your portfolio in precious metals. Morgan Stanley came out and said you ought to have 20% of your portfolio in precious metals, actually specifically in gold. I thought maybe the mainstream is starting to come around to the idea that gold is not a barbarous relic. It is something useful in a portfolio. And then, we hear these things on the pullback, which are just utter nonsense. Until fundamental changes, gold's just happy in the bull market and taking a pause. First thing you do is you buy that gold, that wealth insurance, that proven store of purchasing power for that financial crisis you hope you never have, with basically the highest liquidity of anything out there in the marketplace right now. So start with gold. You still have plenty of upside because even if your motivation is insurance, you're still going to want to see it go up. That's natural. That's ingrained in all of us. Then I think you look to silver for profit.
In this discussion, Checkan outlines how gold's long-term strength remains intact, despite short-term pullbacks and market noise. He highlights that when key indicators align, a falling gold-silver ratio, rising interest rates, and a stabilizing dollar, will begin approaching the later stages of this bull market, potentially 5 to 10 years down the line. He stresses the difference between holding gold for insurance and buying it for profit. The metal, he explains, will continue to do its job preserving purchasing power regardless of fluctuations in price. For those positioned for profit, gradual selling, just as you would gradually buy in, is the smarter move when the cycle matures. Checkan pushes back on the mainstream skepticism that always appears during gold pullbacks. While investors are told to hold on through equity dips, gold buyers are often urged to sell. An irrational double standard, he notes. With respected voices like Ray Dalio and Morgan Stanley now recommending 15-20% exposure to gold, sentiment is shifting. Gold, he says, remains the ultimate form of wealth insurance, liquid, proven, and still offering significant upside. Silver, meanwhile, continues to shine as the opportunity for profit. For more insights like this, don't forget to like, subscribe, and share your thoughts in the comments below.